Ever since the Silicon Valley Bank collapse, banks in the United States have been on edge. First, people started pulling their money out of the smaller banks because they were worried that these regional banks might run out of money and collapse. Then, to prevent this contagion, the Federal Reserve Bank passed the Bank Term Funding Program, which allowed these smaller banks to borrow money directly from the Federal Reserve Bank. That way, even if people pulled their money out of the bank, these banks could continue to stay in operation because they could get money from the Federal Reserve Bank. All of this happened in 2023. Well, now we are entering the next chapter of this banking shift, because on March 11th, 2024, the Federal Reserve Bank ended the Bank Term Lending Program, which means that banks can no longer get this money from the Federal Reserve Bank to stay in operation, and the smaller banks who borrowed money from the Federal Reserve Bank now have to pay this money back. So now with the Federal Reserve Bank essentially taking away the life jacket, this poses two big issues for the banking sector. Number one is it poses that risk for contagion like we saw happen in 2023. And number two is the issue of the commercial real estate market. By the way, this isn't just me saying this. Even the chairman of the Federal Reserve Bank, Jerome Powell, has come out and said that he is expecting that we're going to see more bank failures because of this. Now, the issue with point number one, the potential bank contagion, is probably the most obvious. We also covered this in market briefs, but essentially, if people are worried about their bank and they pull money out of the bank, that hurts the bank's ability to continue operating. We covered this in market briefs, but banks make money by lending money, and when you deposit money in your bank, then the bank has more money to potentially lend out, because banks do something called fractional reserve lending, which means that if you deposit money in the bank, banks have money to lend out to other people. So now, if people get worried about the health of their bank and they start pulling their money out of their bank, well, now that bank has less money to potentially lend out. And if more and more people start going to the bank to pull their money out, the bank might run out of money and might not have all the deposits to give people back their money because they don't keep all of their money in reserves. Remember, they're lending their money out. And so if now these banks can no longer borrow money from the Federal Reserve Bank in case there is this type of fear or contagion, well, you can see why that would be an issue. And there's also a lot more eyeballs on the banking sector now compared to before. For example, New York Community Bank has been getting a lot of press lately because they have a lot of bad assets on their books, and when you hear news like they're being downgraded by a major credit rating agency, well, that makes investors in the bank scared, people who own the bank stock, and they start selling off that stock. So now when you hear news about this stock of this bank falling, well, now people who are depositing their money in the bank also get scared, and then they may want to start pulling their money out of the bank as well. So it kind of becomes a double whammy. If the stock price falls, it becomes harder for the bank to go out and raise more money because the valuation of that stock is lower because, well, the stock price is lower. And then if people are worried about the stock price and they start pulling their money out of the bank, well, now that makes the bank operations more difficult because they have less cash to actually lend money out to, and then they have to keep paying out all these depositors. Now, we've been covering all this in Market Briefs. Like I said, Market Briefs is a free financial newsletter through Briefs Media, where my team is working to break down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read email. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And this brings me to the second issue that I want to talk about, which is what's going on in the commercial real estate sector. Long story short, the values of some commercial buildings, like office buildings, are now falling because you have a lot of offices that are sitting a quarter vacant or half vacant, and some even completely vacant. And so when these buildings are sitting half empty, they're not making that much money and their valuations fall. Well, the owners of these buildings, the landlords of these buildings, are oftentimes not owning these buildings outright with cash. Many times they own these buildings with debt. So now, if you are a landlord and you're going to borrow millions of dollars, tens of millions of dollars, hundreds of millions of dollars, or maybe even billions of dollars, to go out and finance this office building, and now this office building is losing value, and now this landlord is underwater on this office building, well, you can start to see why this poses an issue. Because if the landlord loses the ability to continue making their mortgage payments, well, now that might mean that the bank will no longer continue getting the interest payments on their debts. which means this bank might be holding on to a bad asset, which is now underwater. The reason why I'm bringing this up here is because if you are a regional bank and you're holding on to these commercial real estate loans, which are now starting to go underwater, you can start to see why that would pose an issue, because if you're a regional bank, you're a little bit smaller. You might not have the same resources as Bank of America or JP Morgan Chase Bank to have other assets to fall back on. And if people are worried about your assets and they start pulling their money out of your bank, well, now you can see why that's an issue, especially considering the fact that the Federal Reserve Bank just shut down that lending program. So it's a little bit more difficult for some of these smaller banks to access more money. Now, at this point, you're probably wondering, well, Jaspreet, how much of these commercial real estate loans are regional banks actually holding on to? Let me show you. This is an excerpt from the Fortune magazine article, which says regional banks hold more than 2/3 of the roughly $2.8 trillion in outstanding loans for U.S. commercial real estate properties. So regional banks are holding the majority of commercial real estate loans. Now, not all of this $2.8 trillion of commercial real estate loans are underwater, but a portion of them are, especially when it comes to that office portion. So now, if the regional banks are holding on to a big chunk of these office loans, which are now underwater, when would this be an issue? Well, what we're starting to see happen is that 2024 is the beginning of the readjustment phase of these commercial real estate loans. Remember, commercial real estate loans are not 30-year fixed rate mortgages. They readjust every few years. And 2024 is the beginning of the readjustment period. 2024 is going to start the readjustment of the loans. 2025, we're going to see even more readjusting of these commercial real estate loans. So we know that many office valuations of the buildings are lower today. And we know that interest rates are significantly higher today than what they were in 2020 and even 2021. So now there's a couple things you want to pay attention to. Well, what is going to happen with interest rates? Because if interest rates stay higher for longer, that means as more of these loans start to readjust in 2024 and 2025, that means these office landlords are going to see their payments shoot up. Not just because their expenses have risen, but because their cost of servicing the debt, their cost of making payments have gone up. Again, not because they're borrowing more money, but because it's a readjusting loan. The loan is readjusting, and now as they're readjusted at higher interest rates, their expenses are higher. Now, if you're an office landlord and your expenses shoot up because your payments are a lot higher and your building is half vacant, you might not have the ability to keep making the payments. At which point, it's more likely for you to potentially default. Again, not guaranteed, but your chances of default rise when your income stays here, but your expenses are shooting up. And so this is where now something banks are starting to pay attention to, the Federal Reserve Bank is starting to pay attention to, and it's something that, well, we've been talking about for a long time. We don't know when we'll see the full effect of this, but we know that there are impacts of the higher interest rates. We don't know what the Federal Reserve Bank is going to do. Maybe they'll slash interest rates drastically. I mean, I don't think that they should do that because there's other impacts of that, but that's a possibility that could turn things around. And so there's a lot of different factors at play here, but what I want you to understand is the different things that are happening, especially in the banking sector, because, well, you might hear regional banks get on the news a little bit more, and it's helpful for you to understand what's causing it, what's happening behind the scenes. That way you can be a more financially educated investor instead of being a panicky investor. And remember now, if you're keeping your money in a bank, you're still protected by FDIC insurance, assuming your bank is FDIC insured. If it's not FDIC insured, I don't know what type of bank you're banking with. But if you have a bank, it should be FDIC insured, which means you are protected up to $250,000 per depositor. If it's just your name on that account, it's $250,000. If it's you and your spouse, it's $500,000. Now, of course, just make sure with your bank that it's FDIC insured, which is why you don't want to panic. But understanding that if your money is in a bank and you're FDIC insured, you really don't have anything to worry about. But generally, when it comes to the investment space, I want you to understand the different things that are happening in different sectors. That way you can make more financially educated decisions and not be an emotional investor, but rather be a financially astute investor. And of course, we'll be keeping you updated on market briefs. That way you know what's going on. Jamie Dimon, CEO of the largest bank in the United States, just recently did an interview with CNBC where he said that he thinks investors are too hopeful about our economy in the United States and that investors are too hopeful for a soft landing.
The market is kind of pricing a soft landing. That may very well happen, but the odds at 70 or 80%, I would give them half of that. That's all.